Welcome back to the Deep Dive. Today, we are opening up the 3Q25 earnings and strategic outlook from the world's most critical manufacturer, Taiwan Semiconductor Manufacturing Company, TSMC.
Absolutely critical. Hard to overstate their importance right now.
Right. So our mission here is to quickly cut through the noise. We want to extract the financial health report card, obviously, but more importantly, we're zeroing in on their strategic blueprint. How are they planning to capitalize on this, explosive growth in AI and advanced chips?
Yeah, the strategy part is key. The numbers are backward-looking, but the strategy tells us where they think this whole thing is heading.
Exactly. And we've got the presentation slides, the press release, and the full earnings call transcript to guide us. Plenty to dig into.
Good stuff. Lots of detail there.
Okay, let's unpack this. If AI is the new oil, then, TSMC is basically the world's biggest refinery, right? And these results, they tell us exactly how fast they're ramping up production.
That's a pretty good analogy, actually.
Yeah. So let's start with the hard numbers for Q3, ending September 30th, 2025. These results were strong, slightly ahead of guidance, and honestly pretty staggering. Net revenue hit US $33.10 billion.
$33 billion. That's just massive for a quarter.
It really is. And crucially, that's up 10.1% sequentially, which is, a healthy jump quarter on quarter. But look at the year-over-year number.
Yeah, that's the one.
A huge 40.8% increase compared to last year.
That 40.8% YoY figure, that's the context you need. This isn't just some cyclical bounce. This really confirms that the AI-driven structural demand is real, it's accelerating, and it's way beyond what you'd see in just a normal recovery.
It speaks to the strength of their big customers, right? The ones buying the cutting-edge stuff.
Absolutely. Their leading-edge customer base is clearly driving this.
Right. And the volume shows it, too. They shipped, 4,000, 85,000 12-inch equivalent wafers. That's up almost 10% sequentially.
More wafers out the door.
And diluted earnings per share, EPS, hit NT $17.44, up 39% year over year. So yeah, a pretty stellar report card overall.
Definitely strong financials. But what's really fascinating, I think, is the profitability. Because they delivered all this growth while they're also juggling these, complex global expansion costs.
Okay, yeah. Talk about the margins.
So gross margin hit 59.5%. Just think about that for a second.
59.5%.
Yeah. They beat the high end of their own guidance range, which topped out at 57.5%. They beat it by 2 full percentage points.
Wow, okay.
And operating margin landed at a very, very healthy 50.6%.
Wait a sec. 59.5% gross margin. That seems high. Especially when they specifically mention the drag from starting up those overseas fabs. Plus, didn't they mention unfavorable currency exchange rates too?
They did. Both were headwinds.
So how did they still beat guidance by that much? Where did the cost improvements actually come from?
Well, management pointed to two main things. First, they talked about successful internal cost improvements,
Yeah.
The operational excellence you kind of expect from TSMC.
Standard efficiency drives.
Right. But the biggest factor, they said, was the dramatically higher capacity utilization rate. When demand is this strong, their fabs, especially in Taiwan, are just running flat out.
So they're spreading those huge fixed costs over more wafers.
Exactly. That boosts the margin almost instantly.
Yeah.
So the dilution from the new global fabs starting up, it was basically outweighed by these huge utilization gains back home.
Makes sense. And what about looking forward? Q4 guidance.
They're guiding for continued strength there, GM between 59% and 61%. That suggests they're pretty confident their efficiencies can keep countering those external pressures for now.
Okay, so the financials look great. It means they're selling something really valuable, really specialized. What exactly is it? Which products, which technology nodes are generating all this cash?
It's all about the latest and greatest. So TSMC defines advanced technologies as 7 nanometer and anything more advanced than that.
Right, 7 nanometer and below.
In Q3, those advanced technologies made up a dominant 74% of their total wafer revenue. That's a really key metric. It shows they're holding on to that premium position at the cutting edge.
And within that 74%, what's the breakdown?
Looking closer, the 5 nanometer family was the biggest single piece at 37% of wafer revenue. But then the 3 nanometer node followed really quickly at 23%.
23% from 3 nanometer already? That ramp seems fast.
It is fast, and that's key. It signals major adoption, probably from high-end smartphones and those early AI customers jumping on the newest tech.
And if we look at who is buying all this advanced silicon, the market platforms, that tells a pretty interesting story about where computing power is actually going.
Yeah, the platform view is revealing.
Here's where it gets really interesting. High-performance computing, HPC. That continues to be the undisputed champ. It held flat sequentially, but at a gigantic 57% of net revenue.
57%, just dominant. And that's where your AI accelerators, your massive data center chips, that's where they live.
But the surprise, maybe, was smartphones.
Yeah, smartphones saw this massive sequential recovery, jumped 19% to make up 30% of revenue.
19% jump in one quarter.
Huge jump. And management gave a really critical insight here. They said inventory levels for consumer electronics are now very healthy.
Ah, okay. So what does very healthy imply?
It implies that customers aren't just, scrambling to pre-build inventory because they're worried about supply. It suggests this growth is based on real end market demand picking up again.
That's a positive signal for the broader electronics market, then.
It seems like it. We also saw good sequential lifts elsewhere. IoT was up 20%, automotive up 18%.
Solid growth across the board, really.
Yeah.
And one more stat that always jumps out. Geography.
Right, the concentration.
76% of total net revenue came from customers based in North America.
76%. That figure's
Wow.
just staggering, isn't it? That level of concentration means TSMC's fate is overwhelmingly tied to the strategies, the design cycles, and, yeah, even the inventory management of just a few huge U.S. tech companies.
It really underscores why decisions about, say, their Arizona fab are so critical.
Absolutely. It's all connected.
Okay, let's talk about that strategic decision-making then. The main theme of the earnings call, maybe unsurprisingly, was AI. Management's message was pretty clear. AI demand is, and I quote, more stronger than we thought 3 months ago.
More stronger. Not just strong, they're emphasizing the acceleration of that strength.
Right. This isn't just strong. This feels like a structurally explosive trend they're describing.
Exactly. I mean, they previously forecast that AI accelerators would grow at like a mid-40s compound annual growth rate, CAGR, through 2029.
Mid-40s CAGR is already incredibly high.
It is. But on the call, management subtly updated that. They said the numbers now a little bit better than that, and then they added that the current demand numbers are, quote, insane.
Insane. Okay, that's quite a word from a usually very measured company.
It definitely stood out.
So insane demand usually leads to capacity constraints. What's the bottleneck right now? Where are things tight?
The tightness is kind of everywhere on the advanced side, honestly. Management stressed that both the front end, actually making the leading edge chips and the back end capacity are very tight.
Okay, front end and back end. Explain the back end tightness a bit more.
Yeah, we really need to focus on the back end here.
Yeah.
Specifically, advanced packaging. Things like CoWoS.
CoWoS, chip on wafer on substrate.
Right. You can think of CoWoS as this incredibly precise, high-end way of stacking chips together, often in 3D. It's essential for modern AI accelerators. You can't just, slap 1,000 chips onto a circuit board anymore. You need to integrate them vertically for massive speed and efficiency.
And that specific packaging capacity is the bottleneck.
It's the critical bottleneck for getting AI hardware delivered right now. And TSMC confirmed they're working incredibly hard to try and narrow this demand-supply gap. That includes significantly increasing their CoWoS capacity throughout 2026.
Okay, so meeting this structural demand, this insane demand, requires more investment. They updated their CapEx plans for 2025, right?
They did. They narrowed the range upward slightly. They're now projecting US $40 billion to US $42 billion for the year.
$40 to $42 billion, so up a bit from the previous low end, which was $38 billion.
Yeah, a firm nudge upwards. It's not a massive jump, but it signals commitment.
And they gave some philosophy behind it, too. Management said, quote, a higher level of capital expenditures is always correlated with higher growth opportunities in the following years.
Translation. We're spending big because we see huge growth ahead.
Clearly making a massive long-term bet here. And they said about 70% of that budget is going directly towards advanced process technology.
That 70% number tells you where their priorities lie. It's all about funding the N3, N2, A16 nodes and the associated capacity.
But is this level of CapEx, $40 billion plus, is that sustainable long-term? Does it signal something fundamental shifting?
Well, spending like this year after year, it means TSMC isn't just reacting to a normal tech cycle. They seem to be projecting maybe a decade of hypergrowth that requires them to completely transform their global manufacturing footprint.
So, this spending signals they believe the AI cycle is going to lift the ceiling for all their advanced segments, structurally.
That seems to be the bet they're making, yes. A very big bet.
Speaking of spending and that global footprint, I'm just fascinated by the sheer logistics of it all. How are they managing to expand so quickly in Arizona, Japan, and Germany, pretty much all at the same time? while managing that huge capital spend.
It's a huge undertaking. They emphasized on the call that all these decisions are strictly driven by two things: customer needs and necessary government support. Like CHIP Act funding in the U.S. and similar programs elsewhere,
So customer demand pulls them there, government support helps make it viable.
essentially. And in Arizona, the focus seems to be all about speed and scale, driven by that massive U.S. customer AI demand we talked about.
What are the specifics there? What's new in Arizona?
They said they're speeding up technology upgrades faster than they originally planned. They're moving quickly to N2 and even more advanced nodes there. And critically, they mentioned they're close to securing a second large piece of land nearby.
A second piece of land. What for?
Management used the term independent gigafab cluster.
Okay, what exactly is a gigafab cluster? That sounds a bit like marketing speak.
It kind of does, but it essentially means building a massive, highly integrated production campus, multiple fabs, probably supply chain partners co-located, all designed to be largely self-sufficient. It's about achieving scale and efficiency locally.
So, building a mini TSMC ecosystem in Arizona.
That's the idea. And importantly, to support that U.S. back-end demand, the CoWoS bottleneck, they mentioned they're collaborating with a non-TSMC OSAT partner.
An OSAT, outsourced semiconductor assembly and test, like an Amkor or ASE.
Exactly, one of those specialists. And this partner is apparently breaking ground earlier than TSMC's own two planned advanced packaging fabs in Arizona. So they're leaning on partners to help ease that CoWoS crunch in the U.S. sooner rather than later.
Smart move to leverage the ecosystem. What about Japan and Germany?
Progress elsewhere sounds pretty smooth. In Japan, the first specialty fab in Kumamoto apparently started volume production in late 2024, and they specifically said very good yield.
Good yield early on is always a positive sign.
Definitely. And construction on the second Japanese fab has already begun. Over in Europe, construction of the specialty fab in Dresden, Germany has also started and is, quote, progressing smoothly.
When back home.
Back in Taiwan, they're still investing heavily, of course. Multiple phases of 2-nanometer fabs are being built in both Hsinchu and Kaohsiung science parks.
Okay, let's circle back to the cost of this global build-out. We heard the short-term margin hit was less than they feared in Q3, but what about that long-term dilution forecast? Is that still a worry?
It's definitely something analysts watch closely. So for the full year 2025, the expected dilution from these overseas fabs is now forecast to be just 1% to 2%. That's actually better than the previous 2% to 3% they expected.
Why the improvement?
Mostly because the overall company scale, that massive revenue growth, is just growing so rapidly, it kind of absorbs some of that initial dilution impact more easily.
Okay, better in the short term. But the long-term forecast...
That remains unchanged. They're still guiding for 2% to 3% dilution in the early stages of these overseas fabs ramping, potentially widening to 3% to 4% later on as more capacity comes online.
That short-term improvement is good news, obviously, but that longer-term 3% to 4% dilution, is that really baked in, do you think? Or is management just being conservative? I mean, with the scale of this Arizona gigafab they're talking about, shouldn't they eventually get economies of scale there that keep the dilution lower?
That is the multi-billion-dollar question, isn't it? They are certainly trying to be conservative in their public forecasts. They openly acknowledge the significantly higher operating costs overseas. Everything from utilities to labor is just more expensive than in Taiwan. They express confidence they can mitigate a lot of it through automation, scale, learning curve efficiencies. But that 3–4% forecast probably serves as a necessary safety buffer in their planning until these huge gigafab clusters are fully mature, fully staffed, and running smoothly with a localized supply chain.
So potential upside if they execute really well, but they're not promising it yet.
Exactly. Let's wait and see how the operational reality unfolds.
Okay, let's pivot then to the future tech itself, the stuff that will actually run in these fabs and sustain this growth. We're talking 2-nanometer and beyond. What's the latest status on N2 and this newer node, A16?
Okay, N2. They said it's well on track for volume production later this quarter, Q4 2025. And importantly, they mentioned good yield already.
Good yield at the very start of volume production is impressive for such an advanced node.
It really is. They expect a faster ramp-up in 2026, fueled by both smartphones, probably the next iPhone generation, and crucially, those HPC AI applications.
So N2 is coming online right on schedule. What about extensions or the next step?
All right, this N2 node is quickly being extended. There's N2P, which is an enhanced version offering better performance and power savings. That's scheduled for volume production in the second half of 2026.
H226. Okay.
And also slated for volume production in H226 is A16.
A16, what's special about that one?
A16 features what they call their best-in-class Superpower Rail, or SPR.
Can you quickly break down SPR? What does a superpower rail actually do for a chip?
Yeah, simply put, SPR is about delivering electrical power to the transistors more efficiently. Instead of routing power lines across the top layers of the chip, like usual, SPR brings power in from the backside of the silicon wafer.
Ah, backside power delivery.
Exactly. When you get down to these incredibly tiny transistor sizes, just getting power to them without loss or interference becomes a massive challenge. SPR improves performance and significantly reduces power loss. This makes A16 particularly well-suited for the most power-hungry HPC products. Think next-gen data center AI chips that consume enormous amounts of electricity.
Got it. So better power efficiency for the biggest chips.
Right. And TSMC believes this whole family, N2, N2P, A16, or whatever derivatives follow, will form another large and long-lasting node, similar to how successful their 5mm and 7mm families have been.
Building the next foundation for growth. Now let's talk about that really fascinating paradox that came up during the Q&A session on the call.
Ah, yes, the exponential token growth versus linear revenue growth.
Right. The CEO confirmed that token volume, basically the sheer amount of computation needed for training and running AI models, is increasing exponentially. He even said something like it's almost doubling every 3 months.
Exponential growth, doubling every quarter. That's mind-boggling demand.
It is. Yet TSMC's AI revenue growth KDI forecast is only in the mid-40s% range. Still huge, but clearly not exponential doubling. So if demand is doubling every 3 months, why isn't TSMC's revenue doubling every 3 months? How do you square that circle?
It's a great question, and the answer management gave is absolutely critical. It really confirms TSMC's core value proposition. The resolution to the paradox is node migration.
Node migration,
Yeah.
meaning
Meaning, the reason they aren't selling exponentially more wafers is because TSMC is effectively selling efficiency. Their continuous technology improvement allows customers to move from, say, the 3nm node to the 2nm node.
okay.
So an AI company might still purchase roughly the same number of wafers, maybe slightly more. But because the transistors on that new N2 wafer are so much smaller, faster, and more power efficient, that single N2 wafer can handle exponentially more tokens, exponentially more computation than the older 3nm wafer could.
Ah, I see. They're packing more computational power onto each square millimeter of silicon.
Precisely. They're selling exponentially more compute capability, but they only need, let's say, linearly more silicon volume to deliver it. This massive efficiency gain from moving to the next node is what bridges the gap and offsets the need for an exponential increase in wafer shipments and, therefore, revenue.
So TSMC's innovation itself helps manage the otherwise unmanageable explosion in AI compute demand.
That's the core idea. Without that relentless node shrinking, the AI industry's demand would break the world's manufacturing capacity very quickly.
So what does this all mean? Let's try and wrap this up. This deep dive really confirms TSMC is riding this multi-year wave of just immense strength, doesn't it?
It certainly looks that way. Strong Q3 financials are just the start.
Right. Growth is absolutely concentrated in those highest value advanced nodes for HPC and AI. They've nudged CapEx upward, signaling confidence, and they're executing this incredibly rapid, geographically diverse strategy to build out critical capacity, especially for CoWoS packaging and the upcoming N2 node, all over the world.
It's a massive undertaking on all fronts.
The company is clearly committing huge amounts of capital to AI, treating it not as a cycle, but as the structural foundation of computing for the foreseeable future. They're balancing this unprecedented demand against some really complex global manufacturing logistics and these continuous technology leaps.
It's a high wire act, but they seem to be managing it remarkably well so far.
So the final provocative thought for you, our listener, to consider based on all this, what is it this time?
Well, given the CEO himself confirmed that AI demand is still running stronger than even their already high forecast, how sustainable is this strategy of relying primarily on technological migration, the efficiency gains from N2 A16, to absorb that insane exponential token growth?
Can efficiency gains alone keep up indefinitely?
Can they prevent that exponential demand from completely blowing past even these increased CapEx limits in 2026 and beyond, Will it force even larger, perhaps more dilutive spending waves sooner than expected? And tied to that, what operational efficiencies must they achieve to keep that long-term overseas dilution down at the low end of that 3–4% forecast, especially with gigafab spinning up?
Fascinating questions. Definitely things to watch in the coming quarters as they try to manage this explosive, truly global demand. Thank you for joining us on this deep dive into the world's most crucial manufacturer.
Thanks for listening.
We'll see you next time.